Welcome to this explainer. Today we are tackling what I think is honestly the greatest mystery of entrepreneurship. We're going to look at the core challenge of how founders take a simple, sometimes totally crazy idea sketched on a coffee shop napkin and actually turn it into a massive global company. How in the world does that transformation happen?
Okay, let's dive into this. Picture this. You've got $1 million business idea. It's brilliant, right? You just know it's going to change the world. But then you check your bank account and the reality hits you. You have exactly $500 to your name. Now, most ridiculously successful companies didn't start with endless piles of cash. Actually, they started just like this, with a massive problem and an absolutely relentless drive to convince someone else to invest in the solution.
Which brings us to the ultimate question we're going to answer today. Where does the money actually come from? It's really the overarching mystery of business growth. So today, we're going to follow the incredible journey of a business from that very first simple idea all the way to a global corporation. We'll discover every major way that businesses raise the cash they need to survive and eventually thrive. Here is our roadmap for today. We'll start with the need for capital, then move to bootstrapping and inner circles, banks and angel investors, venture capital and crowdfunding, and we'll wrap it up with going public.
All right, let's kick things off with stage one, the need for capital.
Look, every single company begins with an idea. Maybe it's a better product, a faster service, or some completely groundbreaking new technology. But here is the harsh reality. Brilliant ideas alone do not pay the bills. You need capital. That's the financial fuel you absolutely need to hire a team, build the product, and market it to the world. Without a solid financial runway, even the most world-changing ideas just die right there in the brainstorming phase.
Moving right along to stage two, bootstrapping and inner circles.
In the super early days of a startup, founders don't exactly have access to giant corporate investors. Instead, the very first funding source is usually the founder's own pocket. We call this bootstrapping. Founders will literally use their own life savings, sell personal belongings, or work a second and third job just to fund their dream. Now, the beauty of this is that you keep 100% of the pie. But if the ship sinks, well, you're the only one going down with it. It's complete ownership, but total risk.
So, what happens when those personal savings dry up? Usually, founders turn to their friends and family. And you know, what's fascinating here is that these early supporters are usually investing in the founder as a person, rather than the completely unproven business concept. The checks are small for sure, but they provide that crucial cash needed to just build a prototype or launch version 1.0. Though as you can probably guess, mixing a risky business with personal relationships, yeah, that requires immense trust and some very clear expectations.
Next up, stage three, banks and angel investors. Eventually, the business is going to outgrow the founder's personal network. It needs real professional backing to survive. One of the absolute oldest sources of financing is your local bank. The great thing about a bank loan is you don't have to give away a single slice of company ownership. You just borrow the money and agree to pay it back with interest. But here is the great irony of the bank loan. Banks usually only want to lend you money when you can mathematically prove you don't really need it, which frankly makes it incredibly difficult for a brand new pre-revenue startup to ever get a yes.
Now, what's really interesting about this slide is the stark contrast here. While banks demand these rigid, established track records, an angel investor is totally willing to look past a lack of history. If a startup gets rejected by a bank, they might just turn to an angel who's ready to back the unproven potential of that founder and their wild idea.
So who are these angels? Well, they're typically wealthy individuals who invest their own personal money into promising startups, and in exchange, they get partial ownership of the company. But they offer a startup way more than just a big check. Angels bring what we call smart money to the table. They combine vital strategic advice, deep mentorship, and these crucial industry connections that a traditional bank simply cannot offer.
Let's move into stage four, venture capital and crowdfunding.
As the company finds its footing, we enter the rapid growth phase. So the crucial point is this massive jump in scale. We are officially leaving the realm of individual angel investors and entering the fast-paced world of institutional money. Venture capital. VC firms manage enormous pools of investment money gathered from other institutions, which allows them to write much, much larger checks to startups that are primed and ready to scale rapidly.
But make no mistake, VC firms are not looking for small, safe, steady businesses. VCs operate on something called the power law. They're literally hunting for unicorns. Why? Because just one massive billion-dollar success will pay for the 99 other startups in their portfolio that inevitably fail. It's the ultimate high-risk, high-reward ecosystem. But hey, what if you want to bypass those giant institutions entirely? Enter crowdfunding. Because not every business needs a handful of wealthy investors. Sometimes funding can come from thousands of ordinary, everyday people. So instead of taking one massive check from a VC firm, businesses can just collect thousands of tiny contributions online, and collectively, that crowd can rival a major corporate investment.
The massive advantage here, in most crowdfunding campaigns, founders do not have to give up a single drop of company ownership. Instead, these thousands of backers are incentivized with cool rewards. They might get early access to the product, some exclusive merchandise, or honestly, simply the satisfaction of helping to launch a project they really believe in. Think about it. Some of the earliest VR headsets and smartwatches got their jumpstart this exact way.
Which brings us to our final destination, Stage 5, going public, the IPO. For those incredibly rare, wildly successful companies, this is the absolute final major milestone to scale globally and raise literal billions of dollars. The initial public offering, or IPO, is that ultimate transition where a company goes from being owned by just a few private investors to being publicly traded. Suddenly, millions of everyday people can buy shares of the company right there on the stock market.
But wait, there is a catch. Going public isn't just popping champagne and cashing massive checks for the founders and early investors. It completely shifts the founder's daily life. Instead of just tinkering and building a cool product, you're now managing quarterly earnings reports, adhering to immense amounts of regulatory red tape, and you are constantly answering to your new millions of public shareholders.
And this brilliantly illustrates the complete evolutionary roadmap we've just traveled. From the solitary founder bootstrapping with their own savings, leaning on the trust of family, to gaining the smart money of angel investors, reaching rapid scale with venture capital, and going all the way to the public markets of an IPO. Business financing isn't just a one-time event, it's an ongoing dynamic journey.
So what's the key takeaway here? It's that a founder literally has to constantly adapt. The scrappy, do-it-yourself survival skills you need to bootstrap a business are completely different from the diplomatic finesse required to manage Wall Street investors during an IPO. Every single step up this ladder requires entirely different strategies, totally different pitches, and comes with a completely new set of risks.
Because at the end of the day, understanding this whole life cycle, it's not just about math or banking or term sheets. It is about the relentless, stubborn pursuit of turning an idea into reality. Every single global giant you can think of once faced the exact same problem of figuring out where the money would come from. The difference? They just found the resources to keep moving forward.
So, I want to leave you with this final provocative thought. Think about this entire chronological roadmap we just laid out today. What is your million-dollar idea? And maybe more importantly, looking all the way back at step 1, where will your very first $500 come from?